Okay, so welcome to the afternoon session. So we have 3 speakers for this afternoon session, and the first speaker will be Samuel Jones from Cantab Capital.
Thank you, Hamza. Do I have the clicker?
Should be over there, no?
Available here.
Yes.
Step forward. Okay. Good afternoon, everybody. So my name is Samuel Jones. I work at Cantab Capital, which is the systematic investment arm of GAM, our parent company, and I work alongside Matt, who you've heard from earlier on today. I'm going to talk a little bit today about financial options, which is an area of my sort of special interest and is illustrative of the kind of problems that we face in the finance industry, where we have to bring to bear a lot of these mathematical techniques and mathematical applications, computer science, data science, numerical analysis that we've been talking about and that we're here today to discuss. So first of all, a little bit of a primer on options, what they are and what they're used for. Options as an investment class are they come in 2 flavors. They're essentially the right to buy or to sell an asset at a fixed price. The right to buy is called the call option, and the right to sell is called a put option. And so these are the characteristics, payoff profiles of those 2 flavors of financial option. So on the right-hand side, a call option with an exercise price of 102. If the asset price that I'm interested in looking at has a current value of 100, then the right to purchase it for 102 at the current level of 100 is worth nothing to me until the asset price rises above that level, and then if I have the right to buy it at a level below its current price, it starts to accrete value to me linearly according to how much the price has risen. And conversely, for a put option, if I have the right to sell something for a fixed price, if the current price is 100 and I have the right to sell it for 98, I wouldn't exercise that option unless it were worth something to me. So it's of value to me if the asset price falls below 98, and then I have the right to sell out of it at a level above its current market value. And so these are the sort of characteristic payoff profiles of financial options, which is unusual maybe a little bit among financial assets in that they are non-linear. So normally you think of a financial asset as being, you know, if I own a share in Unilever, for instance, to pick an example, and the price of Unilever goes up, I make money linearly with the price of Unilever shares, and also I lose money linearly as it goes down. And so this is why a lot of the interest comes into the modelling of these things, because of that non-linearity, which we will see and discover. So financial options, they've been around for a long time. Been traded, well, you can look up the history since 1600s and the Dutch tulips and so on, but more recently, since the 60s or so, on the Chicago exchanges, where people have traded options on commodities and equities and currencies and bonds and all kinds of financial assets. And they're now very liquidly well understood, traded across the world by various different participants in those markets. If you have any familiarity with derivatives and have read much about them, you'll know that you know they have a long history of having somewhat of a bad press, perhaps. So from people like Warren Buffett talking about financial derivatives, of which options are a subclass as weapons of financial mass destruction, to stories about people like Nick Leeson imploding Barings Bank back in the 90s through the sale of unhedged options on the Tokyo Stock Exchange. And so my first job, I think, is probably to convince you a little bit of the legitimacy of options as an investment class and what their uses are and why they're part of the portfolio that we trade and how we make use of them and how other people might make use of them. So broadly, users of options might be divided into 2 classes. Hedgers, who are using them to mitigate their risk as an insurance policy against risks that they might have, and speculators who want to have some way of expressing a view on the market and want a sort of more finely tailored way of doing that than having to invest all of their money in the thing that they think is going to go up or the thing that they think is going to go down. So by way of example, you can think of a few in the commodities world. For example, if I were a wheat farmer and I wanted to guarantee the price of my crop next year, and I'm worried that weather is going to impact me adversely, and I want the right to receive a fixed price for it now, then I might be interested in purchasing a put option paying a bit of money now in order that I have the right to sell it and get that income at a later date. Similar kind of use if I'm an airline, for example, and I'm concerned perhaps about political instability in the Middle East and worried that the price of oil is going to go up and that's going to adversely impact my costs because I have to consume oil to utilize it as jet fuel. Maybe I want the right to buy that for a fixed price, and so I could buy myself a call option on oil, and then if the price of oil does go up, then I can purchase it at a fixed price in the future and not be adversely impacted by those price changes. Perhaps slightly more esoteric uses. So from the financial world, if I'm a small portfolio manager and I'm carrying a bunch of high-risk technology stocks, and I'm worried about the fact that there might be some kind of something akin to the dot-com crash of the 2000s, and my high-risk technology stocks are going to collapse in value, then perhaps in that instance, when people are worried about high-risk assets, flee from high-risk assets and move into lower-risk assets, and so the price of gold, for instance, might go up. Maybe I'll purchase a call option on gold, which will in some sense ensure me in that scenario that I'm going to profit as the price of gold goes up when my portfolio goes down, and I have to have a small outlay as an insurance policy to purchase that kind of secondary insurance, if you like. Or possibly as a pension fund might make use of these things. So a pension fund obviously has its liabilities that has to finance people's pensions at the end of the day, and they're worried particularly about a crash in the market, that maybe they will purchase a put option on the stock index, so that in the event of a stock market crash, the sum of that loss to people's pensions is mitigated by the fact that they profit by being able to sell off their portfolio at a predetermined price. And maybe even if they don't want to directly pay for that insurance, they might finance it by the sale of call options on the other side, so that if the market goes up by a huge amount over the course of the lifetime of their liabilities, well, that's very good for John and Mary here enjoying their pension, but maybe they don't actually need all that money. Maybe they'd have preferred to finance that protection on the downside by selling away some of that prospective income that they might receive if the market goes up. So these are some of the kind of use cases that options have in the financial world. So a lot of these instances obviously are to do with insurance. Insurance, when bought and sold, has to have a price, and as Matt discussed previously, so I'm going to talk a little bit about the history of options valuation, and from the sort of earliest start points of starting to bring to bear mathematics to these markets, all the way through to our sort of where we are now with big data and lots of information that we have to incorporate into this. And so the start point really was, as Matt mentioned earlier on, the Black and Scholes in the 1970s, who made the first realization that you could apply some mathematical techniques to derive what the correct value should be for an option on a financial asset. And so in particular they noticed that in the case of my call option here, if it's priced there as that orange dot, you can say, well, if suppose this is the price of oil, if oil goes up or down by a certain amount, I'm going to have a certain sensitivity to that amount, and that's equivalent to me holding a certain number of barrels of oil. And if I continually adjust a portfolio of oil or stocks or commodities, whatever it may be that underlies that asset, if I continually adjust it such that it has the same sensitivity as the option overall, then at the end of the day I must end up replicating the final payoff of the option. So this is a process called delta hedging, hedging your risk according to the delta, or the change in value for a small increment for the underlying asset. And so if you delta hedge the portfolio, you can replicate the payoff of the option, and therefore the option value has to be the same as the portfolio of the asset that you have to start with. And so with a little bit of mathematics, you can derive what the process should be for enacting this portfolio under certain assumptions about whether you can easily sell the stock short where you need to, and that you can trade continuously and without transaction costs. And at the end of the day, you derive the fact that the price of the option has to satisfy the heat equation. under the assumption that its price, the underlying asset, has a diffusive behavior driven by Brownian motion, as shown on the top line of those equations. So this is quite an interesting effect, because these results from classical physics and the solution of numerical PDEs and the heat equation and how heat dissipates in a homogeneous medium are applicable perhaps to modelling financial assets, and how the price of an asset diffuses in space in the same way as a particle diffuses in space in dissipation of heat. And so you end up with a PDE that you can solve, and then you can derive what this price should be, this orange line. So for a given, at a point in time, if I make assumptions about how volatile the asset is going to be, I can work out what the probability of my asset ending up in the money, meaning worth something to me. I can work out what that should be, and it turns out it's the solution of the heat equation, and so I can write down this rather involved looking formula at the bottom there, which not to go into too much detail, but the key point to recognize is that point about volatility. It really is, because I don't really have any so much impact to the direction of the asset price moves, because those can be hedged away by trading in the underlying asset. Really, the key point to be taking into account in your modelling is how volatile we think the asset is, and so that's this quantity sigma here in the model for the underlying asset price. So that gives us a little bit of idea about what options are, why they're used, and the beginnings of how we try to model and understand their price behaviour. We can notice that the sensitivity of options to the volatility is shown by these other lines. So if the asset is more volatile, I have a higher probability for the put option. I have a higher probability that it's going to collapse in value, and so if I have a higher probability that it's going to collapse in value and therefore pay me off at some point in the future, it has to have a higher value now, which is the higher line. So as I increase, if the volatility of the asset were to increase, then the price of the option increases. Conversely, if it were to decrease, then the price of the option decreases. And the same is true of the call option as well, because volatility being a measure of the standard deviation of the asset over time, we're concerned with how likely it is to go up just as much as how it is to go down. So whether I have a call option or a put option, its sensitivity to how volatile the underlying asset is always positive. And in particular, you can work out, if I can see the price of the option in the market today, then I can work out what the volatility has to be in order to justify that price of that asset. And so this is something called the implied volatility. And implied volatility is a sort of alternative measure of the price of options that doesn't take into account, if I've got a portfolio of many different options across lots of different assets, across lots of different time horizons, across lots of different exercise prices, I can make a comparison of them in terms of their implied volatility. How volatile does the underlying asset have to be in order to justify that price? So that de facto became the measurement of price for options as they became more liquidly traded over time, since through the 80s, 90s, 2000s. And so we can look at the price of options in terms of their implied volatility, and what we find is we've got quite a lot of data here. So for example, these are the implied volatility numbers for WTI West Texas Intermediate oil futures as of yesterday, and this is across different ranges for that exercise price, the rate at which I can buy or sell, and across different time horizons going out from, I think this is in weeks, so going out to half a year. And we find that different options, even though they're on the same underlying asset, the same oil, same number of barrels of oil have to be deliverable in each of these contracts, the implied volatility for them is very different. And in particular, you can see that if I'm looking at the right to sell and not sell oil at $40 a barrel, it is priced as though the volatility of that oil price is much higher than the right to sell option to sell oil at $50 a barrel, which is a bit confusing potentially. So this can happen for one of a couple of reasons. Oh, sorry, come forward. A couple of reasons that give rise to this effect are, firstly, we made the assumption that the asset price in our pricing model, in that Black-Scholes model, was driven by a geometric Brownian motion, that the returns of the asset were Gaussian in distribution. Gaussian distribution we know its properties well, but in general people might be concerned that the distribution of the asset prices have slightly fatter tails than is predicted by a Gaussian distribution. So given the standard deviation, the volatility level, it doesn't say anything about the higher moments of the distribution. In particular, crashes in asset prices happen rather more frequently than a Gaussian distribution would predict. And so this apparently higher volatility is actually just reflective of the fact that that those probabilities are, the characteristics of the fatter tails of the distribution, the higher probability of ending up in that region. And that's one potential reason why we see this kind of pattern, and that is indeed the case. It's not the only reason, however, because the other reason is that people's investment preferences, when people are wanting to buy options as an insurance, as we discussed, for various different reasons, in particular if they're wanting to insure themselves against a crash in oil, their investment preferences come into bear. So people care a lot more about losing large amounts of money than they care about making small or losing small amounts of money. And so they're willing to pay perhaps over the odds for the insurance that they're going to lose a large amount of more money in their portfolio. And so perhaps this is reflective of the fact that options are not only reflective of higher probabilities of extreme events, but also that people are willing to pay even more than the fair value for the probability of those events. And so this gives rise to this kind of behavior when you look at the prices of options in their implied volatility terms. And so the problem is trying to understand and characterize this information in a sensible way. And so throughout the sort of 1990s and early 2000s, banks and financial institutions went to a lot of effort to try and model this phenomena. And so starting with our constant volatility model, Black-Scholes, which gives rise to the heat equation, we can augment this, and here's an example of a stochastic volatility model. So we can see here the similar equation for the stock price S, ds equals mu SDT, so it's got some kind of drift, and again very similar, we've got sigma SDW, so it has some volatility, but the sigma has a subscript T saying that it is time dependent and it follows its own diffusion process, and without going into all of the details of the characterization of this model, basically you end up with a volatility that's not constant, but a volatility that can change over time, which is an empirical thing that we observe, and so that makes sense that we should have this kind of behavior for asset prices, because sometimes the market is more volatile than other times, and that itself is a random process. And so what we get from that random process, well, if volatility changes, that's like the standard deviation of our distribution is changing, so we have something a little bit like a mixture of Gaussian models. And so a mixture of Gaussians is a heavy-tailed distribution, and that then gives you higher prices of options that insure against extreme events, and consequently when viewed in terms of their implied volatility, you get this kind of nice upward motion in the so-called wings of the volatility surface. The values of those extreme events is elevated when looked at in implied volatility terms. And so this was what, these are the kind of approaches that were taken to try and model this effect. Unfortunately, you find yourself coming across more and more problems when you try and take this approach and apply it to real-world data. So, by way of example, one such thing that we talked a little bit about how the price of options are related to the probability of them expiring in or out of the money, of them expiring with positive value or not. You can formalize this a little bit, and we can say that if I view the price of call options, i.e. the right to buy, as a continuum over the various different exercise prices, so right to buy at 50, at 60, at 70, over a continuous range of prices, and if I'm given those prices as a continuous function of k, which I use to denote the exercise price here, and I take its derivative, I can recover that probability density function. And so I can kind of invert the problem and say, not what's my distribution for what's my distribution that I'm going to use in my model, and therefore what does it recover in terms of the prices of the options that I'm trying to understand. But the inverse problem, if I've got a set of options that I observe in the marketplace that people are continually buying and selling on the exchange, and then I take those and I back out what the probability distribution should look like, you find maybe some weird characteristics. So, for instance, here we have something that's very nearly a bimodal distribution, and so this might be characteristic of something like a specific event. So again, considering the oil price, suppose we're a few days ahead of an OPEC meeting, and we know that members of OPEC are going to meet and discuss whether or not they're going to restrict or increase production of oil, and that's a binary event. It's going to go one way or the other way, and so consequently you'd expect if there's going to be an increase in supply, price is going to go down. If there's going to be a restriction of supply, price is going to go up, and so you might have the market might have a view, which could be reflected in the option prices, that the implied probability density is something like this. I'm going to have, it's applying a certain probability to those different events, and then a diffusion around that. So the difficulty with actually trying to model the underlying physical process, as we were doing before, looking at stochastic volatility models and trying to add in more complications into them to try and represent these different characteristics, is you're always going to be faced with sort of additional information, things that this kind of approach can't be accurately reflected in a process where the volatility itself is diffusive, because I'm going to have discrete jumps, and so I need to add some more features into my model, and so maybe I need to kind of make the thing more complex. And so again, a lot of industrious work was done in the last 20 years in building stochastic volatility models with jumps in local volatility and jumps in the asset price and the implied jump distribution, modeling different events and putting them all into modeling approaches for the asset price itself. Unfortunately, if you go down that route, of continuing to trying to build a model for the asset price and working out what that should mean for prices of options on that asset, you're going down a little bit of a rabbit hole, and this little result here is a bit of the sort of the nail in the coffin, mixing my metaphors a little bit there, for that kind of approach. Basically what it says is that if I have two different processes for the asset price, so one driven by a volatility process sigma t here, and the other driven by a volatility process sigma bar t here, if they have the same conditional expectation, so conditional on the asset price reaching a certain level at a certain point in time, if the expected value of those volatilities is the same, then the marginal distributions of those price processes, two different processes, are the same. They might not have the same joint distribution. That means I might not have the same conditional distribution, so they might not predict the same probability of the oil price going down to 30 given that it's gone up to 60, but they will have the same marginal distribution for a fixed point in time. It will have the same prediction of the asset price being at 60 at a particular point in time. So what that means is I can have two different models that will predict the same outcome and the same option prices for that expiry. And in particular, if I just set my volatility process to be equal to that conditional expectation, then I've got a very, very simple model, but one that isn't really very reflective of sensible real-world dynamics, but is still guaranteed to recover my option prices. And so the process of adding more complexity into models and adding arbitrary features in to try and capture the empirical effects that you see in the markets in which these options are traded, it just unravels very quickly, because you're now in an infinite model space where you can make an arbitrary selection to just try and capture the things that you see on a particular time. So a much more sensible approach, now that when we consider that a lot of this modelling effort was done perhaps in the early days, where people were interested, where we didn't have observable option prices, they weren't traded in the same liquid way, we didn't understand what their prices and behaviour were, they weren't published on the exchanges, and so we needed to have models for the underlying physical process of the asset. Or potentially we wanted to value other more complicated products that had conditional dependencies. So before the financial crisis of 2008, investment banks were very involved in selling complicated structured products that had lots of conditional dependencies on the interdependencies between different behaviours of different assets at different times to expiry, which isn't really the problem we're concerned with here when we're just trying to observe and understand the risk in the financial options that we can trade. And so a much more productive approach in this case, where we've got lots of data, lots of well understood information, is not to go after modeling the physical process, but to take a much more data driven approach and say, right, we're going to fit a non-parametric form to this implied volatility surface that we have and try and understand its characteristics and its behavior. We still need to know a lot about all of that information, all of that understanding that we've built up about the behavior of underlying asset prices, because there are certain conditions that we have to meet. We have to make sure that if we fit some non-parametric form to this data here, that it still comprises a valid density function. It still comprises a valid kind of predictive model for what what option prices should be. So it doesn't make any sense that the right to buy something for a lower price should have a higher price than the right to buy it for a higher price, if that makes any sense. It does make sense, but I maybe didn't state it quite so well. Options at successive expiry prices have to have decreasing value, because otherwise you're saying I'd rather buy something for 20 than I would buy it for 10, which doesn't make any sense. And so those characteristics have to be captured within the particular form of non-parametric fit that you get here. So we have all of this input data. As we can see, sometimes it's noisy. This is a particularly nice looking example, by the way, because sometimes it's even noisier than this. Sometimes our data just stops at one particular section, and so we get a week-old data sitting in here. And so we have to have we've got a lot of considerations to build into this problem when we're trying to fit a sort of very high-dimensional non-parametric form to all of that data. When we've got maybe 5,000-6,000 input data points which can influence it, we're concerned about things like outliers. We're concerned about things like robustness. We're particularly concerned about these things because we're in a live trading environment in our case, where our investment decisions from 1 hour to the next are premised on the data that we get out of these models. So it's no good to say, oh no, it's gone a bit wrong there, it's all gone skew whiff, let's just run the model again, because we have to be in the market all day every day, managing clients' money, running the strategies that we are doing, and prudently judging the risk that's coming out of them. To do this kind of approach, you basically need all of the techniques that we've discussed at length a little bit earlier on today, things like convex optimization problems with particular choice of loss function, using robust penalties to make sure that you're robust to outliers, constraints on the characteristics of this functional form, which you can derive from knowing the relationship between the implied volatility data that we have and its relationship to the pricing data. There are constraints on the slope of this thing in the extreme limits that say something about the existence or otherwise of the moments of the distribution. So we want to make sure that the variance of our distribution is well defined, and so there's results that say that this has to be can't have a slope greater than 2, for instance. And so you can build all of this stuff into a well-behaved convex optimization problem that lets you fit this green function stably and smoothly through all of the potentially noisy data consistently, and that then builds you the function that you're interested in looking at. So what we find then is that we're able to take a much more kind of empirical statistical approach to risk factor modeling than we were doing before, when we were trying to look at deriving complicated stochastic calculus models for the underlying asset price. So for instance, you can see here the things that we care about when we're running and managing a portfolio of financial options. We care about the behavior of the volatility surface, because that is going to change the value of the assets in our portfolio. And we care about the realization of volatility, and because that's going to have an impact on whether or not we are in or out of the money. So rather than trying to build a model for it, we can look at just building this non-parametric fit through all of our data and then analyzing it over time. So for instance, here we've got the first 3 principal components of, if you can imagine this thing moving around dynamically as people get more or less concerned about the volatility in markets. It's going to move up or down. The prices of our financial options that we hold in our portfolio are going to be impacted by that. That has certain statistical properties, and so now we're in the game of understanding the statistical properties of that distribution, that multivariate infinite dimensional distribution of this whole surface. And so these are the first 3 principal components of that distribution, and then we can look at our portfolio and forecasting, not fitting a model to it and saying, well, it has to have a certain behavior because the parameters of my model say it has to be so and has to be so for all time, but we can just look at forecasting these things, and they're conditional forecasts dependent on other information that we might have at our disposal, such as macroeconomic data or the behavior of other asset prices. And this allows us to condense down all of those 6,000-7,000 assets into 3 or 4 factors that will drive the behavior of our portfolio, and allows us to manage the risk and understand what decisions to make utilizing that information. I'm going to skip quickly over this slide because I'm running a little out of time. But the point being that what we have at the end is once we've been able to forecast the behavior of that function that we've carefully built, we can then make predictions around what kind of risk we hold for particular assets in our portfolio, and so we can work out what the characteristics of its profit in the portfolio and how it's going to contribute are going to evolve over time. So putting it all together, in the end, what we find is that the returns on our option portfolio, if we're holding options in our portfolio, depend on all the moving parts of all of this data. So the realized level of volatility of the asset, the level and shape of this implied volatility surface that we have, our forecast dynamics of how we think this is going to move around as it reflects people's opinions about how the market might potentially move in the future, the correlation between the behavior of this implied volatility function with the underlying asset price itself. When the asset goes down, does this go up or does it go down? And the characteristic risk inherent in each option that we have in the portfolio. So the risk that we have is measured by what's the term, the Greeks, because each one is given a sort of starting with a delta, which is the deviation of the price for a small asset price change, the various other nonlinear components of the risk of an option with respect to its volatility or its change over time. All of these factors contribute a little bit in this large sort of non-parametric multi-factor model to the profit that a particular individual option in the portfolio contributes. And so then the problem becomes looking at this in a very big data context. You've got lots of this information, we've got many options, and we have to make optimal decisions around when and where to transact in those, which ones we should hold in order to mitigate our risk or in order to take a particular direction or view. And so this is the case for just one individual point on this surface. When we're trying to manage all of these risks, we are effectively looking at building all of this information into another large portfolio optimization problem, and then says, given all of our forecasts, all of our data, all of these input information, how can we then make those decisions in order to best serve the interests of our portfolio and of our clients. So in conclusion, just to recap, financial options, they're widely traded assets with many uses in both managing risk and in improving the investment returns in the portfolio. And the use of options in systematic investments, such as the style that's undertaken at Cantab, involves lots and lots of data and various different numerical and mathematical techniques, which we've hopefully shown some examples of. And there's lots of intersection between current practice and new research. And hopefully I've given a bit of a flavour as well of the way that that practice has evolved over time from the 19th century mathematics of the heat equation through to the sort of big data and interesting information that we are studying today. Thank you very much.
Any questions for Sam? Yes.
Hi. Sorry if I get the phrases slightly wrong, and you might have said it, but what are the inherent timescales in your problem in terms of, so from an investment perspective, you've kind of got what you're looking back to fit your model, and then how often you're redoing that model, and then what's your investment horizon? So could you explain a little bit?
A little bit, yes. So the investment horizon that we might typically be looking at, so the traded listed options tend to be over a horizon of anything from a week out to a year or so, and so typically, the most liquid and most traded options people are concerned about maybe their risk in a month's time, or maybe shorter dated than that. It does rather depend on the case. And so those are the kind of timescales that you're looking at in terms of investment horizon, and the strategies that we might run in a large portfolio would be concurrent with those kind of timescales, and they might be hedging strategies, ensuring our risk. They might be directional strategies where we're actively taking more risk through the same instruments. But those are the kind of timescales that we'd be looking at in terms of the target investment horizon. In terms of actively managing that, this process that's running all of this data and recalibrating and deciding when to take decisions is on a much more fine-grained timescale, because we care, you know, if information comes up at 3:15 on a Friday afternoon that changes our mind, we want to enact on that information. So the whole sort of machinery of this thing is running on not as good as continuous basis. And then in terms of the information that we might use to fit that model, I mean, typically our sort of backtesting horizon would go back as far as we can to you know, listed options data going back to the 1990s. But then you have to be very cognizant of all of the usual problems of overfitting and in and out of sample and so on. So, but fitting the behaviour of the implied distribution at one point in time, that's a point in time problem. That's one snapshot, and so there's various different pieces in the machinery, if that makes sense.
Yeah, that makes sense. Thank you.
You mentioned that investors are more afraid of taking risk than taking profits. And how do you account for that in your modeling of the option process?
So that effect, I mean, it rather depends on which market you're looking at. So that's particularly true in equity markets, because everybody who's invested in equity markets has a natural propensity to be long, because the market overall has to have ownership of all of the companies that underlie the stock index. And so it's an observable fact that the prices of options as insurance against the crash are more elevated in equity markets, whereas, for instance, in currency markets, where purchase of one currency is effectively the sale of another, and so it has that kind of that mirror image effect where it's effectively a swap. You get maybe a little bit less of that skewness in distribution. And so measuring it and understanding it, again, it's a statistical problem of looking back over history and understanding the difference between the realized distribution of asset returns and the implied distribution of asset returns. And everything that you're looking at here is in terms of the implied distribution of asset returns, and that's directly inferable from the market prices that you see. And then the problem is precisely that's precisely the question: how can we judge whether that is a good or a bad representation of what we judge is actually going to happen, and therefore is there any relative value in buying or selling options at this particular time? And that's, well, I won't say a secret, but it's complicated at least.
Okay, so we're running a bit. So 2 quick questions. Yes, yeah, please go ahead. Yeah.
So if I understand correctly, here you have one underlying and many options, right, with different strikes and expiration dates. But do you get more out of this if you look at the basket level, for example? Because the underlying themselves can be correlated. So
yes, absolutely. So that's the next level of complexity, and it is something that we definitely do have to consider. Particularly, so for instance, government bond futures. You have options on government bond futures, in particular the US Treasury bonds, which the liquid contracts are 2 years, 5 years, and 10 years, and 30 years, and so there's options on all of those, and obviously they're very correlated, because if 10-year interest rates go up, then 30-year interest rates go up, and so that is, yes, it's definitely a consideration. It has to go into the modelling process, and it's another level of complexity on top of what we've got here that we do have to incorporate.
You had a question.
Can I ask, does the system protect against bubbles in the market, irrational belief?
Yes, I have to say yes. So, do you mean the system that we run, our internal investment management process, or the system of options as a traded instrument on an exchange?
Make it easy. What you've just described on the board, does it offer any protections against that irrational belief?
Well, I mean, the prices of options as an insurance contract are reflective of the market's opinion of the potential risk of a crash happening. Obviously, when a serious crash does happen, so you can look back at the history of prices of options on the US stock index, on the S&P 500, for instance. and look in particular over, so the VIX index, which you might have heard of as the fear index, is essentially a weighted portfolio of these option contracts, and so you can look at its behaviour as a measure of how concerned people are about the risk inherent in the market overall. And you do see, if you look back over history through 2008, that it's sort of spiked considerably from its regular value of 15 or 20 up to 80 or so around that point in time, and so it's a reflection of people's concerns about that, but it's only a reflection of people's concerns. It's this is market information that's reflecting back what investors believe, in the same way as a stock price is just a reflection of what people believe the fair value of the stock price is. So it can't have any inherent predictive power over or any inherent kind of understanding of those kind of phenomena, but it does reflect them hopefully to some extent. I hope that sort of answers the question.
Okay, so let's thank Samuel again.